Navigating the investment landscape. Unraveling the distinction between active and passive investing. In the vast realm of investment strategies, two distinct approaches dominate the landscape: active investing and passive investing. Understanding the nuances of these methodologies is essential for investors seeking to align their portfolios with their financial goals. Let's delve into the core differences between active and passive investing, unraveling the intricacies that define each strategy and examining the implications for investors. Active investing. The quest for alpha. Active investing is a proactive and hands-on approach where fund managers or individual investors actively make decisions to buy or sell securities with the aim of outperforming the market. This approach is rooted in the belief that diligent research, market analysis, and timing can lead to superior returns compared to a benchmark index. Active investors often engage in frequent trading, seeking opportunities to capitalize on market inefficiencies or mispricings. One of the key features of active investing is the pursuit of alpha, a measure of a portfolio's excess return beyond what is expected based on its risk profile. Portfolio managers employing active strategies rely on their expertise, research capabilities, and market insights to identify undervalued securities or time the market to maximize returns. While the potential for outperformance exists, so does the risk of underperformance, as active managers may incur higher fees and transaction costs. Consider a scenario where an active fund manager meticulously analyzes economic indicators, corporate financial statements, and industry trends to construct a portfolio aimed at outpacing the broader market. This approach requires continuous monitoring, quick decision-making, and a deep understanding of market dynamics, making active investing a dynamic and demanding endeavor. Passive investing. The serenity of indexing. In stark contrast, passive investing, also known as indexing, embraces a more hands-off and systematic approach. Passive investors seek to replicate the performance of a specific market index, such as the S&P 500, rather than actively selecting individual securities. This strategy is grounded in the efficient market hypothesis, which posits that markets are generally efficient, making it challenging for investors to consistently outperform the market over the long term. Passive investors achieve market exposure by investing in index funds or exchange-traded funds, ETFs, that mirror the composition of a chosen index. The appeal of passive investing lies in its simplicity, lower costs, and the ability to capture broad market trends. By avoiding the need for continuous market analysis and stock picking, passive investors benefit from reduced portfolio turnover and associated transaction costs. Imagine an investor who chooses to allocate funds to an S&P 500 index fund. This investor essentially owns a slice of the 500 largest publicly traded U.S. companies. As the market fluctuates, the index fund automatically adjusts its holdings to mirror the composition of the S&P 500, providing a low-cost and diversified exposure to the overall market. Cost considerations. A key point of distinction. One of the fundamental differences between active and passive investing lies in the cost structure. Active management typically incurs higher fees due to the intensive research, analysis, and trading associated with the strategy. These fees are often expressed as a percentage of assets under management, AUM, and can erode a significant portion of potential returns, particularly over the long term. Passive investing, on the other hand, is renowned for its cost efficiency. Index funds and ETFs typically have lower expense ratios compared to actively managed funds, as they aim to replicate the performance of a benchmark rather than actively engage in research and stock selection. This cost advantage becomes particularly pronounced over extended investment horizons, contributing to the appeal of passive strategies for long-term investors. Risk and reward dynamics. The risk and reward dynamics inherent in active and passive investing further distinguish these approaches. Active investors embrace the potential for alpha, actively seeking opportunities to outperform the market. However, the quest for alpha comes with heightened risks, as market timing and stock selection can be unpredictable. While successful active managers can deliver stellar returns, the risk of underperformance and the associated higher costs are inherent challenges. Passive investors, in contrast, accept market returns without attempting to beat the market. By tracking a benchmark index, they aim to capture the overall market's performance. While this approach mitigates the risk of underperformance relative to the benchmark, it also means foregoing the potential rewards that can come from skillful stock picking and market timing. Market conditions and investor preferences. The choice between active and passive investing is often influenced by prevailing market conditions and investor preferences. During bull markets, when broad market trends are favorable, passive strategies may shine as investors seek to ride the upward trajectory of the overall market. In contrast, during periods of market volatility or economic uncertainty, active managers may find opportunities to capitalize on mispricings or defensive strategies. Investor preferences also play a crucial role in shaping the active-passive dichotomy. Some investors value the potential for outperformance offered by active strategies and are willing to pay higher fees for the expertise of skilled fund managers. Others prioritize cost efficiency and simplicity, gravitating towards passive strategies that align with a buy and hold philosophy. Conclusion. In the labyrinth of investment choices, the decision between active and passive strategies is a pivotal one that reverberates through an investor's entire portfolio. The active approach, with its pursuit of alpha and active management fees, appeals to those who believe in the potential for skilled managers to outshine the market. On the other side, passive investing, with its emphasis on low costs and broad market exposure, attracts investors who prefer a more hands-off and cost-effective approach. Ultimately, the choice between active and passive investing hinges on individual goals, risk tolerance, and the conviction one holds regarding market efficiency and the ability to consistently outperform. Whether navigating the dynamic currents of active investing or riding the steady waves of passive strategies, investors must align their chosen approach with their financial objectives, recognizing that both avenues offer unique advantages and challenges in the pursuit of long-term wealth creation.